Mike Tedeschi, Wealth Management Advisor at Perspective Wealth Planning with this week's market breakdown video. We're going to take a look at the four major U.S. indexes. We'll also take a look at the U.S. dollar as well as commodities. And we finally have less than 75% of the S&P 500 components trading above their 200-day moving average, which ends the longest streak going all the way back to 1928. We'll take a look at what that's meant for us moving forward historically. But first, let's jump right into the S&P 500. Now, we had a little bit of weakness here over the last week, right, with a couple of down days as we can see. But what did we not do? We did not make a lower low. Remember, this is still intact. We have a series of higher lows on the S&P 500, and we still have a series of higher highs. All right, until we take out this low right here, that is still intact. Okay, so this weakness we saw over the last few sessions, we haven't breached any technical levels of importance yet. We'll keep watching, but right now, no concern. When we look at the Nasdaq here, same thing can be said. I think we had that beautiful ascending triangle break out there in June, and since that point in time, it's been nothing but higher lows and higher highs. Still in that uptrend, even though we had a couple of days of weakness, didn't break any of the major charts, nothing to be concerned about at this point in time. When we take a look in at the Dow, right? The Dow has been a bit weaker here, right? We led the first half of the year. Right, we led the first half of the year here, and then from that point in time, it's kind of just traded sideways for the most part. We do had higher lows, but as you can see right here, we did take out this previous level from back in August. Now, really the way that I'm taking a look at the Dow is more along the lines of we're trading in a sideways range like this, okay? I would be more concerned if we broke underneath that 33,000 level back down in here. And really I'm looking for that follow through here to the upside, right? This is sort of reminiscent of the Russell when we look at no real price appreciation over the last 5 or 6 months. Now, the Russell's been trapped in the range since the beginning of the year. The Dow, really, it took until the middle of March. But if we look here at the Russell, right, once again, we're trading right in the middle of the zone, right? We pulled back from up around that resistance level, and where are we now? We're right in the middle of that range. Same comments apply that I continue to say. I think where the Russell ultimately goes is going to be very, very important. All right. If this were to break down, this has been the weakest area of the market this year from an index perspective. And if that does break down, that would be a sign that we need to be a bit more cautious, because that lagger all of a sudden starts leading to the downside. You have the potential for the other indexes to follow. But we're not there yet. We haven't gotten there at all. We're still trapped inside this range, and this very well could just be a nice sideways digestion of that big push before we get our next leg higher. We're not going to speculate whether we're going to break down or break up. The probabilities would be more towards the upside because the move came from down below, but we're just going to wait and continue to watch like we've been doing in the Russell to get our next understanding of where we're headed. And when we look at the U.S. dollar over the last couple of months has a series of higher highs and higher lows, as you can see, but that is in the context of this downtrend. And when we back the chart up to a monthly basis, it's really in the context of about a 6-7 year sideways action where we're still trapped in the bottom of the range. The U.S. dollar is a messy chart. We know that. Look, if we get back up over that 94, that 93 to 94.5 zone, this area right here, that changes the way this chart is shaped. We know the U.S. dollar moves slowly, and as it sits right now, it's still just kind of a mess. So there's not a whole lot to glean from this other than watch the upper end of the zone and watch the bottom end of the zone for potential next moves. Now let's jump in and let's take a look at some commodities. First and foremost, let's take a look at oil. We've talked about oil here for quite some time in between this 60 and 75 zone. You can see here we get about 5 years on this chart. All right, this is that really important level. We haven't broken down, we haven't broken out. And if you look at what we've accomplished here as of late, we still have, sorry about that. We still have a series of higher lows. All right, even on this pullback right in here, we didn't take out these important weekly lows, and we have a series of higher highs. If this goes and pushes and makes a new high, then of course that trend continues to stay in. If we kind of chop around in here, then we end up more in this wedge flag pattern again coming from down below, which has a higher potential for a resolution to the upside, but we know major resistance at that 75 zone. So I get very interested up over that 75 to 77 area in the oil market. As it sits right now, I am just watching and waiting to see where that next directional move is going to be. Now, if we're going to talk about commodities, we have to talk about nat gas here, because the move that we've seen has been incredible, right? We were about $1.40 last year, and we're all the way up at $5.50. So that's a huge move. When we look at this chart right here goes all the way back to 2008, 2009, which is all the way back on the left side of 2007. But this important zone right here between basically $5 and $6 is that major decade-long resistance, and we are now clearly in that zone. If we zoom in now on a daily time frame, you can see we have just shot straight higher really since the middle of August, broken above that $5 level. It's one of the most interesting looking commodity charts that's out there right now. We'll back that up and look at it on a monthly time frame. So going all the way back now to 1996, we can see the importance of this area on the chart as a big battleground zone for the last 20 years. Up over $6, there really doesn't have a whole lot of resistance until we get into about that $9 zone there on nat gas. We're going to continue to watch this. Nat gas has always been extremely volatile. It makes some big moves. We're aware of that. But again, on a technical basis, up over that $6 would be a big change in this market. Now, speaking of changes, let's take a look at Palladium. Palladium, which had been the leader, clearly fell back below that 2200 level. Like between August and March this year, Palladium traded between 2200 and 2500. When it finally broke over 2500, we got that big push to new all-time highs. The first test back right here, right? We held and made a nice bounce, but we put in a lower high, right? And then we ended up breaking down below that zone, running into that same area and failing sharply, right? This now is a very broken chart. It was the best looking of the precious metal space. It is now one of the worst, okay? We look at platinum. Platinum doesn't look very good either. It's trading right at that really important level from the last 3 to 5 years. When we go back and we look at this trading above 1,000, this chart's really, really, really strong. Runs into that 1300 resistance, falls all the way back down. This is kind of that last zone here for the platinum bullets. If we fall below that 900 level, there's not really a whole lot of reasons to own it. When we look at this in on a monthly time frame, we're still in the context of a much larger downtrend, and this just is that last kind of area of really importance before, really we can kind of open up to the downside. Now, gold still cannot get its act together. We've looked at this every single week. We were above that 1800 level for the last week or so, kind of fighting there. Today, it's it's starting to drop back down again. We are still like right where that breakout zone was from last July. We haven't accomplished much. After that big push, we've slid back down. We clearly have held the 1670 zone. That's going to be the key to this chart. If we fall below that, again, there's not a whole lot of reason to own gold. If we can stay above that and get that next push in the context of the larger picture, the multi-year chart. I mean, this goes all the way back to 1970. This does, and we've said it before, we'll say it again, look like that potential bull flag, right? And there's that all-time kind of high close zones right at that 1800 from back in 2011. And so, back up over 1800, some good things can happen. In between 1800 and 1670, it's kind of no man's land. So we'll keep watching that. Silver not having a very good day today. You can see over the last month or so, it is in that downtrend. We had traded sideways basically since last July with no price appreciation or depreciation, whereas gold had that big push and then slid back. So silver had been the stronger chart for a while. It still hasn't tested these lows, whereas gold has. At 22, underneath of that, this chart doesn't look very good anymore, and we are getting pretty close to that. We're sitting at that 23 zone. A month or two ago, we were up around 26, 27. So this is, not performed well over the last couple of months. But the best way that I can say that we can take a look at this chart still is just a sideways trading range like this. All right, we need to move over 29 or below 22. In between there, it's just kind of chop city, and that's what we've basically seen now for a year out of the silver market. All right, now let's take a look in at copper, right? Copper in between 4 and 450, right? We look at this, and this, this zone right here comes from that breakout, and those highs all the way back in 2010, 2011. We've come up into that zone. We have not been able to follow through here to the upside. We had a little bit of a breakout above, made some new highs, and immediately fell back down, right? This feels like a lot of these commodities where we got these sideways basically since March with no price appreciation, trying to figure out where that next move is, right? We had an incredible move from the downside up. We've digested that move, and the question, of course, is going to be, are we going to continue through to the upside, or was that the end of it? Was this kind of that false breakout zone right in here to those new highs, and then it's over, right? A lot of these are messy charts. We don't have a whole lot in the commodity space that's trending whatsoever outside of nat gas, and as we talked about, we were still running into some major levels there. So, commodity space still kind of a mess at this point in time. Now, when we look into the S&P 500, we had more than 75% of the members above its 200-day moving average. Okay, now for 210 days, and that is where the streak died. All right, and the weakness that we had here over the last week or so. Now, when we look at the actual numbers behind it, there's only 4 or 5 zones where we see more than 200 days with the S&P 500 members of 75% above their 200-day moving average, which really doesn't give us a whole lot of information when you have so few signals, right? It is very positive 3 and 6 months later, right? And one of the ways that you can think about this, we've had such a strong run for a while. As soon as you see a little bit of weakness, buyers have been conditioned to buy that dip, and over the next couple of months, they do buy that dip, and we have seen better results over the next 3 to 6 months. We were positive 100% of the time with this reading, which is not necessarily what you would think when you start hearing more stocks trading underneath their 200-day moving average. That doesn't sound great. If we relax this from 200 days down to 100 days so we get more data points, we see a very similar result. We can see right here, 91% of the time we're positive 3 months, 6 months later, and we're almost 70% of the time positive 1 year later. So again, we have enough data points at this point to really glean some value from it. After we've had such an incredible run, that first kind of area of weakness, the dip tends to get bought historically, and we end up in a good spot 3 to 6 months out. So we'll keep that in mind. As always, I hope you guys found this information useful. You can reach out to me at mtedeschi at Perspective Wealth Planning, or give me a call, 814-580-9881. Stay safe out there, and I will see you guys next week. Take care.